Hi guys, welcome to module number 6. In module number 5, we talked about the basics of markup calculation. And there are actually different types of markup calculations that we use to assist us in merchandise planning and evaluation. So we are going to look at these different types of markup in more details in this module and next two modules. Particularly this module, we're going to talk about the initial markup. Before we get into the different types of markup, shall we refresh our memory about the basic markup calculation? When we talked about the famous important three cases of markup calculations. The first case was when the cost and retail dollars are known, and we're supposed to calculate markup percent. Then the formula is going to be, okay, so that's R minus C over R. Again, the markup percent is retail dollar minus cost dollar over retail dollar. Okay. The next case is when we know the retail dollar and markup percent, and we want to calculate cost dollar from them. Okay, what will be the formula? Cost dollar equals R dollar times 100% minus markup percent. Great. The last case, when we know the cost of the merchandise and we know our markup percent goal, and we want to figure out then if we apply the cost and markup, then what will be the retail price? Okay, in that case, retail dollar equals, right, so it's cost dollar divided by 100% minus markup percent. Okay, retail dollar equals C dollar divided by 100% minus markup percent. So we have just taken a look at the three most popular, most frequently used cases of the markup calculation. The reason why I wanted to go over this before we get into different types of markup is because we are going to repeatedly utilize these three cases, the concepts that we just covered in the three cases, and apply them in different contexts to calculate different types of markup related problems. So we'll take a look at them in next slides. So we know that markup is directly related to the profitability of your merchandise because markup affects the pricing, which will affect the sales and the amount of markdowns that you can afford to have. And markup directly relates to the gross margin, which has an impact on profit. Right? So the markup planning is basically the same as a GM, or gross margin, or profit planning. And when relating markup to profit, we have to consider three different types of markups. Because the retail price doesn't stay throughout the season, usually it starts with the original retail price or initial retail price, but with the markdowns and discounts and all the things, the retail price can actually go down, and which will change the markup percentage you can achieve. So throughout these different stages of operation, you have to calculate different types of markup. And the three types of markup that we most frequently calculate are initial markup, cumulative markup, and maintained markup. And we're going to take a look at one by one of these three types of markup. And especially in this particular module, we are going to focus on the initial markup. From the basic RCM relationship, we know that markup is the difference between the retail and the cost. So the three different types of markup that we're going to talk about basically are using the same concept, markup equals retail minus cost, except that what retail and what costs are actually used for the calculation of the markup will differ depending on the types of markup. Here, the first type of markup, initial markup, when we think about this, the initial markup calculation uses the initial retail or the original retail or first retail as the retail figure and the build cost as the cost figure. The original retail is the first price that you plan when you purchase the merchandise. You know, it's kind of like suggested retail price type thing. The build cost is the planned cost that you think the vendor is going to invoice you. when you purchase the merchandise. This cost can change later on as you actually get this merchandise. In case you pay early, you may get cash discount, things like that. So this build cost is not necessarily the cost that you may end up paying, but this is the initial planned cost, initial quality cost. Okay, so the initial markup is the difference between the original retail and the build cost. So the R minus C equals M. That concept still maintains, except that it is initial M, initial markup, and the R is original retail, and the C is build cost. Okay. Here I'm showing this formula saying initial markup dollar equals the original retail dollar minus build cost dollar. Okay, obviously this markup equals retail minus cost applies to dollar figures. And we'll take a look at the percentage figure in the next slide. Initial markup is also called a mark-on or an original markup. They all mean the same thing. As I said before, the initial markup is a planned figure because you're looking at the planned original retail price and the planned build cost. So it's kind of like the difference between the hoped for retail price or original retail price and the planned cost, the planned build cost. And initial markup dollar equals original retail dollar minus build cost. Then let's take a look at the initial markup percent. How do we calculate initial markup percent? Initial markup percent, just like any other markup percent is percent of retail, right? In this case, the initial markup dollar uses the original retail as the retail figure. So for that reason, the same goes for the retail for the calculation of the IMU percent. So the IMU percent is a percent of original retail. Okay, so that gives us the first formula of IMU percent, which is the initial markup dollar over original retail dollar. Then, given the fact that IMU dollar is the original retail dollar minus build cost, we can replace the IMU dollar portion of the formula with the original retail dollar minus build cost dollar. So that makes the IMU percent formula to be original retail minus build cost divided by original retail dollar. Now then, let's think about the concept of original retail. So original retail basically means it's a hoped for or planned retail price. So then if you think about the relationship between original retail and net sales, the net sales could have been actually sold, the items could be sold for the original retail price, or the items might have been sold with any markdowns or discounts and things like that, so some reductions might have happened from the original retail, right? So if you think about the relationship between original retail and net sales, the net sales plus any reductions that you might have had to taken in the price, the retail price, from off of the original retail price, if you just add them together, net sales plus reductions, that makes the original retail. Right? Or original retail minus net sales will be the reductions. So using this concept, we can actually replace the original retail dollar, that part of the previous formula, with net sales plus reductions. So the third IMU percent formula will be now net sales plus reductions minus build cost over net sales plus reductions. Just replacing the original retail from the previous formula with net sales plus reductions. So now we see all these three different formulas. They're all using dollar figures to come up with the IMU percent. They are first the initial markup dollar over original retail dollar. The second one is original retail minus build cost over original retail. The third one is net sales plus reduction minus build cost over net sales plus reduction. And these all mean the same thing. Right? So depending on the problem that we are facing, depending on what numbers that we already know, we can calculate the IMU percent by using any one of these formulas. So let's keep the three formulas in our mind and work on this first example problem on initial markup. So let's say last year the dress department buyer achieved net sales of $125,000 with total reductions of $15,000 from a group of evening dresses purchased at $60,000. So we've got the net sales dollar and reductions dollar. Reductions include markdowns and discounts and shortages that might have happened in our inventory altogether. And then this group of dresses were purchased at $60,000. So that $60,000 will be the cost, or build cost in this case. And what was the markup percent the buyer initially applied on the dresses? So we're trying to kind of deduct what would have been, what was the planned initial markup percent if everything happened the way that the case describes. So here we go. We know the net sales, we know the reductions, we know the build cost. Let's calculate the initial markup percent. Let's pause the video here. Let's take a look at the answer together. Among the three formulas of our IMU percent that we just looked at on the previous slide, probably the third one will work the best because we already know the net sales and reductions and build cost. Let's plug in those numbers. So net sales plus reductions minus build cost over net sales plus reduction will be the formula to be used for this question. Net sales of $125,000 plus reductions of $15,000 minus build cost of $60,000. That's constitute the the numerator. And now the denominator is the net sales plus reduction, which are the original retail. So that's $125,000 plus $15,000. And if you solve this equation, that will give us 57.14% initial markup percent. This question was asking what the initial markup percent was. But what if the question was asking what the initial markup dollar was? Okay, if that was the question, initial markup dollar will be just the numerator portion of the formula here. Okay, because initial markup percent is initial markup dollar over original retail. We know that the bottom part of the formula, which is the net sales plus reduction, is the original retail. Then the top portion, the net sales plus reductions minus build cost, it will be our initial markup dollar. So that the whole numerator portion will be our initial markup dollar. As we discussed earlier, the initial markup is a planned figure, planned markup. And when we try to plan a good initial markup percent that's appropriate for our operational plan, sometimes we don't start with the markup percent itself, but we start with the gross margin plan. We may have a good idea about how much gross margin that we need to actually achieve. And we may also plan our reductions in terms of markdowns and sales discounts and shortages. Based on the previous few years of history, we may have a pretty good idea about how many percent of reductions we may have to actually take on from our original retail price to constitute our net sales. And from these numbers, we may have to sometimes drive what would be the best or good kind of initial markup percent that we need to apply on our merchandise when we purchase the merchandise or when we decide on the first price of the merchandise. Based on this concept, and the fact that initial markup percent is the initial markup dollar over original retail dollar, we can utilize this gross margin and reductions in the formula to calculate IMU percent. So we already know that original retail is the same as net sales plus reductions. So in place of the original retail, we could put net sales plus reductions for the denominator portion of this formula. And for the numerator portion of this formula, we already know that IMU dollar equals original retail minus build cost, which is the numerator part of the IMU percent formula. And then we already know that original retail is the same as net sales plus reductions. And then there's the build cost. The difference between build cost and cost of goods sold is the alteration and cash discount. Build cost is the initial cost that the vendor may charge you or you plan to pay, whereas the cost of goods sold is the actual the cost that you ended up paying. Okay, so when you have a planned cost, when you plan the cost, you don't necessarily have you don't pay alterations when you plan. and you don't know exactly how much cash discount you're going to get. So those two things makes the difference between the build cost and cost of goods sold. So build cost is the same as cost of goods sold minus alteration cost plus cash discount. And if we plug that idea in, then the IMU dollar equals net sales plus reductions minus cost of goods sold plus alteration minus cash discount. Okay? And net sales minus cost of goods sold is the same as gross margin, so that's where the gross margin came out, and reductions plus reductions, and the alteration and cash discount are figured in here. So that makes the numerator gross margin plus reductions plus alteration minus cash discount. And basically that is the same as initial markup dollar, or initial markup, or that's the same as original retail minus build cost. For us to utilize this formula in actual problems, we may use all dollar figures for every number, every term in this formula. So it could be gross margin dollar plus reduction dollar plus alteration cost dollar minus cash discount dollar divided by net sales dollar plus reductions dollar. You can calculate IMU percent that way. Or we can utilize all percentage numbers for all these terms. So that will be gross margin percent plus reductions percent plus alteration cost percent minus cash discount percent. Divide that by net sales percent plus reductions percent. And in that case, all percent numbers have to be percent of net sales. That kind of makes the net sales 100%. Okay, we'll take a look at both dollar and percent based calculation formulas for IMU percent in the next slide. So in summary, the IMU percent equals gross margin dollar plus reductions dollar plus alteration dollar minus cash discount dollar. So ALT is alteration cost and CD is cash discount. And you divide that by net sales dollar plus reductions dollar. Okay. Or you use all percentages and percent of net sales. So gross margin percent of net sales, reductions percent of net sales, alteration cost percent of net sales, and cash discount percent of net sales. Divide that by 100% because net sales is 100% plus reductions percent. And in either way, whether you use all dollars or percentages, you will be able to plan your IMU percent. Just don't mix them up. In case you use dollar for gross margin, you have to use dollars for all the rest in the formula as well. If you use percent for one, then you have to use percent for all the rest. Another thing that we want to remember is the gross margin dollar and gross margin percent plans sometimes can come from knowing how much profit we want and how much operating expenses we think we're going to pay. From the earlier modules, then we know that gross margin is the same as operating expenses plus profit, right? Because gross margin minus operating expenses is profit. So in case we know the operating expenses dollar or profit dollar, then we can combine them together to constitute the gross margin dollar in this formula. Or if we have a planned operating expenses percent and profit percent, all these things planned out, in that case we can utilize those two numbers to calculate gross margin percent. And in that case, this formula can become a little bit more complex, so that operating expenses dollar plus profit dollar plus reductions dollar plus alteration dollar minus cash discount dollar over net sales dollar plus reductions dollar will be IMU percent. And the same logic goes for the when you use all percentage numbers for every term in this formula to calculate IMU percent. We kept talking about reductions so far in many cases, and let's kind of clarify what reductions actually mean. Reductions are any reductions in value of the original retail that had to happen to our merchandise due to the markdowns that we had to take, any sales discounts that we take, or any stock shortages, missing some stock in the inventory and things like that, so that the value of the merchandise have reduced from the original retail that we planned to the actual retail value of the merchandise that we have. So any of those kind of things are combined to constitute reductions. So reductions include markdowns and sales discounts, and sales discount can include two different kinds of things. It could be employee discount, like special discounts that we give to our employees, or some special customer discounts that, like if markdowns are applied to all customers during the markdown period, customer discounts are applied to a certain customer, certain group of customer. So that it may be customers with a certain coupons or customers with certain records, just some special kind of customer with discounts that we give, which will reduce the retail value of the merchandise. And stock shortage is the difference between the book inventory, what the record said that we should have, and the physical inventory, which is the actual inventory that we physically have in our store. Any discrepancy that happens between the record inventory and the inventory that actually we have physically will be considered as a stock shortage. It may happen because somebody stole the merchandise, or just some kind of clerical error, record error that may cause this kind of thing. In whatever way it is, sometimes we do experience stock shortages. So reductions dollars will be basically combination of all the dollars of these three categories, all the markdown dollars plus all the sales discount dollars plus shortage dollars. Whereas reductions percent would be percent figures in these three categories: markdowns percent, and sales discounts percent, and shortage percent. And all these percentages are again percent of net sales. So markdowns percent out of the net sales, sales discounts percent based on the net sales dollar, shortage percent based on the net sales dollar. All combining them all together will lead to the total reductions percent. One thing that I want to draw your attention to is the customer discount, okay, which is part of the sales discount. Customer discount is also C&D as an acronym. We took a look at another CD before, right? That was cash discount. Okay. Then how are cash discount different from customer discounts? The difference is pretty clear. Cash discount is the discount that the vendor gives to the retailer, the buyer, okay, for the merchandise the buyer buys in a wholesale price. Whereas the customer discount is the discounts that the retail gives to the consumer, the customers, for their retail purchase. Okay, so who gives the discount to whom? That's different between the cash discount and customer discount. Again, cash discount is what the discount the vendor gives to the retailer, whereas the customer discount is the discount that the retailer gives to the consumer. Okay, so let's work on a few problems of the initial markup calculation based on the latest formula that we looked at. So that is initial markup percent equals gross margin plus reductions plus alteration cost minus cash discount. Divide that by net sales plus reductions. And we know that we can utilize either all dollars figures for all of these terms in the formula, or percent numbers. Okay. In this first example that we're looking at right now, a store has gross margin of 48%, markdowns of 11%, shortages of 1%, employee discounts of 3%. So we're given all percentage numbers. Okay. Based on this, let's try to calculate the IMU percent. One thing that we need to remember is reductions, right? Reductions include markdowns and sales discounts and shortages. And sales discounts include both employee discounts and customer discounts. So remember that in your when you apply the IMU percent formula to answer this question. Let's pause the video for a while. Okay, let's take a look at the answer together. So we first wanted to know what reductions percent was. So that would be the combination of markdowns and shortages and sales discount all together. That was 15%, 11% markdown, 1% shortage, and 3% employee discount. We didn't have any customer discounts, so that just the 3% employee discount will be the sales discount portion of this formula. So reduction of 15%. Let's utilize that to calculate the IMU percent now. Gross margin was given as 48%, so reductions, we just calculate it to be a 15%. There was nothing mentioned about the alteration, so we're going to assume that it was 0% and no cash discount was mentioned, so let's just put 0% for that too. And then the denominator, which was net sales plus reduction, and net sales percent is always 100%, and plus the reductions percent will be 15%, and that comes up to 54.78% IMU that we need to apply. Okay, let's work on another problem that's very similar to the previous problem. In this case, this casual fashion, this company expects expenses, that's operating expenses, of 31%, and reductions of 6%, and cash discounts of 4.5%. In order to achieve a profit of 11%, what initial markup is required? So here is the idea of a planning initial markup based on our operating expenses plan and profit plans and the reductions and cash discounts plan. Let's utilize this. First, you will have to utilize the profit and expenses to come up with our gross margin plan, and then figure that gross margin and the rest of the figure in the formula for the calculation of initial markup percent. Let's pause the video here for a second while you're working on the problem. Okay, so let's take a look at the answer together. Okay, first we want to solve for the gross margin given the operating expenses and profits percentages. Operating expenses of 31% and profit of 11%. That makes us need the gross margin of 42%. Okay, if we want to achieve a 11% profit and want to afford to have 31% operating expenses, then we need to have a 42% gross margin. And plug that gross margin figure in the IMU percent formula. That will be 42% gross margin plus 6% reductions that was given in the problem, plus alteration, which was not given, so that will be 0, minus cash discount, which was given as 4.5%. Okay, and then divide that by 100% net sales plus reductions of 6%. And if you solve this equation, that will come out as 41.04% of IMU. Great. Alright, let's work on another problem. Okay, in this case, we are given a lot of different numbers, and they're all given in dollar figures. So let's calculate IMU percent using all these dollar figures. Okay, again, remember IMU percent equals gross margin plus reductions plus alteration minus cash discount over net sales plus reductions. Well, we've got planned net sales, so we will have to utilize that. Cash discounts given. Rent, utilities, miscellaneous expenses, miscellaneous payroll. All these four categories of expenses will constitute operating expenses. And we have a planned profit of $25,000. So operating expenses and profit will have to be combined together to calculate gross margin first. Okay. Then there's also markdowns. MD represent markdowns. And employee discounts and customer discounts and shortage. All these four things will have to be combined to constitute the reductions, dollars. Okay. Let's work on the problem while pausing the video. Okay, let's take a look at the answer. Okay, first we knew there were four expense categories that we need to combine to know what the operating expenses are. Rent, utilities, miscellaneous expenses, and payroll. Combine them all together, that was $71,000 of operating expenses. For calculating gross margin, operating expenses, and profit had to be combined. That was $96,000 gross margin. For reductions, we had four different things that were given, and combining all the numbers together, markdowns, employee discount, customer discount, shortages, it was $35,000 reductions. Then finally plugging in all these numbers together in the IMU percent formula, will be gross margin of $96,000 plus reductions of $35,000 plus no alterations, zero alterations, minus $3,000 cash discount that was given in the problem, and divide the answer by net sales of $250,000 plus reductions of $35,000. And that leads us to the answer of 44.91% IMU. Alright, so in this module we took a look at the initial markup carefully as one of the types of markups. And we learned what the initial markup is and how to calculate initial markup dollar, initial markup percent. Especially for initial markup percent, we took a look at 4 different formulas that all give the same initial markup percent figure. And we also learned how we may sometimes use gross margin or profit and operating expenses and all those kind of the P&L skeleton components to plan our initial markup percent. And this concludes module number 6. And don't forget to work on module problem assignment number 6. And thanks for listening.